Hello and welcome. Did you know that the international trade system, the very mechanism that delivers your morning coffee and your smartphone, is also one of the three primary methods criminal organizations use to move illegal funds around the world? For trade financial professionals, this presents a massive problem. How do you facilitate legitimate commerce while stopping terrorists, drug cartels, and fraudsters who hide behind mountains of legitimate-looking shipping documents? If you are looking to understand the intersection of banking operations and financial crime regulations, you are in the right place. In this video, we will demystify trade-based financial crime compliance. We're going to move past the dense legal text and explain how this works in practice. By the end of this video, you will be able to identify how criminals manipulate trade, the specific rules banks use to stop them, and the red flags that signal danger. Here is our roadmap for today. 1. Defining the threat, TBML. 2. The rulebook and regulations. 3. The first line of defense, CDD. 4. Red flags and warning signs. First, we must understand the crime itself. When most people think of money laundering, they imagine suitcases full of cash. But the modern reality is far more sophisticated. We call this trade-based money laundering, or TBML. TBML is the process of disguising the proceeds of crime and moving value through trade transactions to legitimize their illegal origins. The key word here is value. Criminals don't always need to smuggle physical cash. They just need to manipulate the value of the goods being shipped. This is often done through over-invoicing or under-invoicing. Let's use a clear analogy to explain this. Imagine a criminal wants to send $1 million of illegal money to an accomplice in another country. If they try to wire that cash directly, the bank's alarm bells will ring immediately. So instead, they use trade. The criminal buys $1 million worth of luxury cars. However, when they ship these cars to their accomplice, they falsify the invoice. They state that the cars are only worth $500,000. The accomplice receives the cars, sells them for their true market value of $1 million, and pockets the difference. They have effectively received the illicit value without a single suspicious cash transfer occurring. This is the art of pricing manipulation. Now that we know how they do it, how do we stop it? Banks operate under a dual definition of compliance. Historically, this just meant checking if shipping documents match the terms of a contract. Today, it means adhering to laws designed to stop financial crime. There is no single global police force for trade. Instead, we follow standards set by the Financial Action Task Force, FATF. These standards are adopted into national laws, like the Bank Secrecy Act in the US. But here is the challenge. A bank cannot physically check every single container on a cargo ship. It's impossible. This brings us to a core concept, the risk-based approach. Regulators do not expect zero failure. They expect banks to identify specific risks based on their customers, geography, and products, and allocate their resources to the highest risk areas. However, there is a legal hurdle called the independent undertaking. In trade finance, banks deal with documents, not goods. If the paperwork looks perfect, the bank is generally legally obligated to pay, even if the goods inside the container are defective. Compliance officers have to balance this strict legal obligation to pay against the need to stop the transaction if they suspect fraud. So if we can't check the cargo, what is our best defense? It's knowing exactly who we are doing business with. We call this customer due diligence, CDD. You've likely heard the term KYC, or Know Your Customer. In trade finance, this goes deeper than just asking for a passport copy. It requires understanding the customer's entire business model. Criminals often hide behind shell companies. These are entities with no active business or physical assets. To counter this, compliance officers must identify the beneficial owner. A beneficial owner is the actual human being who ultimately owns or controls the company. If you are analyzing a limited liability company, you cannot stop at the company name. You must drill down through the layers of ownership until you find the natural person at the top. If a bank cannot identify who this human is, they generally should not open the account. Because we rely on data and documents, we look for red flags. A single red flag doesn't guarantee a crime, but it signals that we need to investigate. The goal is to spot things that deviate from normal business patterns. Let's look at 3 specific examples. 1. Geographical inconsistencies. Does the shipment make economic sense? If you see shipping documents for bananas being exported from Mongolia, that is a major red flag. Mongolia is known for snowy mountains and deserts, not tropical fruit. If the goods don't match the geography, stop and investigate. 2. Dual-use goods. These are items that have legitimate commercial uses but can also be used to create weapons. For example, high-grade aluminum tubes. They can be used to make bicycle frames, or they can be used for nuclear centrifuges. Banks must screen for these to ensure they aren't violating sanctions or aiding weapons proliferation. 3. Phantom shipments. This is where documents are presented for payment, but the goods never actually existed. The paperwork is purely a fabrication to move money from point A to point B. Now, let's address some common questions that come up when learning this. Is a red flag proof of guilt? Not necessarily. Context is key. A high-value transfer might look suspicious for a small bakery, but completely normal for a car manufacturer. Compliance is about context, not just rigid rules. To summarize what we covered today. 1. TBML moves value, not just cash, often through price manipulation. 2. Compliance balances the obligation to pay documents against the risk of financial crime. 3. Due diligence requires drilling down to the beneficial owner. 4. Red flags help us spot anomalies like phantom shipments or geographical errors. Trade finance compliance has evolved from a simple paperwork check into a sophisticated defense system for the global economy. I want to leave you with a question to think about. As we discussed, criminals are using more advanced technology to forge documents. In your opinion, how will artificial intelligence change the way we detect these crimes in the next decade? Will it make it easier for banks or easier for criminals? Let me know your thoughts in the comments below. If you found this breakdown helpful, please click the like button and subscribe for more content on trade finance compliance. Thank you for watching, and I'll see you in the next video.
Stay ahead in the world of global commerce. Subscribe to Vanijja for expert analysis, and don't forget to like this video.